Joining me now is Julie Biel, Chief Market Strategist at Kane Anderson or Rudnick. Julie, it's great to have you on, and it's interesting to hear that. Are you looking at names that could potentially benefit from all that capex spending by those four heavy hitters that we just laid out?
I think that's the place where I would say there's the most risk. We've seen a lot of companies rallying on the idea that the picks and shovels of this capex are going to be big beneficiaries. But the problem is that you have a lot of customer concentration risk involved in that. And that's the concern that I have is you're relying on four boards of directors to continue to be extremely brave without a lot of evidence that they're going to earn a great return on this investment. And that's a concern for me. So I would rather companies that are already starting to use generative AI in their own operations, in software, small caps are a great example. This technology is a great leveler. I think it's actually going to enable a lot of smaller businesses to compete with larger businesses. And if you look within small cap software, there are a lot of nice niche businesses that are profitable and that haven't really benefited from the high beta rally that we saw in the third quarter.
Okay, let's name some names.
So, companies I like are Descartes, which has a real information advantage in trade. They account for something like 2/3 of packages shipped touch their network. They have real barriers in that business. There's an Encina, which is really enabling a lot of small banks to be more competitive with the larger banks. And despite a really tough mortgage market, they continue to grow their business, which I think is pretty impressive. I think these are the types of kind of smaller cap businesses who can leverage generative AI right now to accelerate their product roadmaps, but they're also integrating a lot of this AI into their own products to be more compelling for their customers.
There's been a lot of commentary, some of it explicit, some of it maybe implicit. When I think about Jamie Dimon's comments earlier today in an interview around the froth in AI and whether a bubble is inflating here or whether there's much further to go and the hype is real. You mentioned where you see risk in the AI trade. How are you thinking about this, and how is it, I guess, going into your investing thesis overall for this market?
Well, it's like, look, I've been spending a lot of time in therapy, and so especially couples therapy, and we always say, it can be both, right? We want to acknowledge that it can be both. So I genuinely believe that this transformation that we're seeing in technology, it's existential. It's going to be impacting us through the next decade. I really believe that, it is real. It is not crypto. It is not 3D printing. This is a real tech transition that we're experiencing. I also believe that most tech transitions don't move in a perfectly linear way, and that we could have periods where we have major overinvestment and they're not able to really recoup all of that investment in a way that is great for investors. I worry sometimes too that this could be like aviation, where all of us really benefited from the innovation in aviation, but the companies actually flying and building the planes didn't start to really earn a return until the 90s. I don't think it's going to be quite that extreme here, but I do think that these numbers are really large, and they mean that they're really hard to create huge businesses around them. And I just think we need to keep that in mind.
If I step back and just look across the market more broadly, I mean, it seems like expectations are pretty optimistic going into Q3 earnings season. Do you fall in that camp?
Yeah, I do. I think things are looking great. I'm so impressed with companies' ability to manage through the level of uncertainty that we had. We were talking about it as toxic uncertainty. I think one great thing that's happened and that really enabled companies to be more flexible is that with the pandemic and the supply shortages, every company really looked at their supply chain and tried to figure out how to be more resilient. And they got to test that right away with tariffs. I think what we will see in the next 2, 3, and 4 quarters is how they integrate and how they change their cost structures to try to withstand some of the blows of tariffs, right? We know that most companies right now are the ones shouldering the burden of tariffs. Will that move over to consumers? I think we're not really going to know that until probably the fourth quarter.